right, Rich, thanks so much. I tell you what, it's a pleasure to be here. It really is, and I appreciate Rich and Dan letting me be here, to be honest with you. But basically, these are winning the game pre-harvest workshops we've been doing. We did a series of them across the state this year. We did a series of them across the state last year. And then last year, too, we did a series of webinars starting in March, going through about August, and we're going to start that again this year. So that's what we're kind of running through today. And just for anyone who's never been to one of our workshops, or for anyone who didn't join any of our webinars last year, basically, Winning the Game is a program, marketing program. Was developed by Ed Ussett from the University of Minnesota, and Rich Llewellyn and Dan O'Brien from K-State applied, and they got a grant from the North Central Extension Risk Management Education Project to kind of fund this program in Kansas, and that's why we're here. So I really appreciate it. My name is Mark Nelson, Director of Commodities with Kansas Farm Bureau. And so again, I'm just kind of here for the ride. What I'd like to do today is, in very just quick order here, is just kind of review some pre-harvest marketing plan outlines. And I define that as simple pre-harvest marketing plan templates from the Winning the Game team, providing relevant examples for pricing increments, targets, and decision dates to help guide decisions. And when you go through our workshops, that's kind of the three things that we really hit on. Trying to set on relevant pricing targets, pricing increments, and then decision dates to help drive action. And so I'm going to share some of those. Let's see here. I am going to also flip off the video just so I can see the slides better. But I do want to reiterate that these are not recommendations or advice, okay? These are not recommendations from K-State. They are not recommendations from Kansas Farm Bureau, but we do believe these are relevant examples for 2023 and things that people should be thinking about. And if you want to kind of look at it, it's good food for thought. Maybe they can still be very beneficial. So let's, no further ado, let's get kind of moving here. Let's see. Okay, so I want to review 3 pre-harvest marketing plan outlines. Wheat, which began back in October. Right, October 1. Corn and soybeans, which we began on January 1. And then more specifically, I want to examine 2 areas that we probably all here in Kansas need to focus, or maybe even start thinking about making some adjustments in our plans. When we create a marketing plan, one of the goals is to create a plan that you're not going to need to make many adjustments in, right? We want a plan that we just implement. Right? We want it to be able to handle a lot of situations, but we are seeing some things going on. And so specifically, I want to look at bushels to price pre-harvest. So how many bushels are you really including in your pre-harvest plan? Additionally, I want to talk about minimum target prices. And so kind of flashing in there, the Kansas Drought Monitor. This is the last one that came out last Thursday. Another one will come out tomorrow. It's kind of in the background, but from it, you can kind of see a couple of things. Nearly, I think it's like 74.92% of Kansas is either in D1, which is moderate drought, or D4, which is severe drought. And I'd argue that's roughly 90% of Kansas wheat. And so that's a real problem. Now, typically, when I create let's see here. When I create a plan, I'll kind of say something like, well, let's insure our crop at 80% or 75 or whatever you insure at, and then use that percent of your APH as the bushels that you want to price pre-harvest. And so, I say 80% of APH. If you're insuring at 75, maybe that would be a good target, because the idea there is that those bushels then would be able to, if you didn't produce it, your insurance will cover that. So it should give you the confidence to go ahead and price it. The question that we've all got, though, is, are we going to produce 80%? Are we going to produce 75% of our APH? Because, again, 75% of the state is in D1 to D4 drought. The last crop conditions, 17% of the Kansas crop was in good to excellent. 52% of the Kansas wheat crop is in poor to very poor conditions. So I think really when we think about our wheat plans, we probably want to think about making some adjustments there. So the second thing is pre-harvest plans should include what we call a cost of production based minimum target price. And we try to say, let's add a little cushion to that, creating a value in which no sales will be made at prices below this. And so I've got a bit of an example here using some cost of production estimates from Kansas State. These basically are the averages, calculated averages for the non-irrigated cost of production over the 6 cropping districts. So Northwest, Southwest, North Central, South Central, Northeast, Southeast. And I just took those and I got the total cost of production, the average yield across the state, and calculated out a cost per bushel. And so sort of a statewide then would be 501, soybeans 11.44, and wheat $7.72. Again, these are from K-State. You can go to agmanager.com or BW Ag Manager to find those. And but I think Dan, Greg Eibendahl, Rich, Sarah Lancaster, the group that puts those together do a great job. Are they exact? Maybe not. Do they reflect everybody individually? Obviously not. But for a state average, I think they're pretty dang good. And then I've got my sample cushions: 49 cents for corn, 56 cents soybeans, 28 for wheat. Again, as you can see, I'm trying to just kind of get a round number for my minimum cost of production value. So for corn, I'm using $5.50, $12 for soybeans. Wheat, we're at $8. But the question is, and I've got some concerns here on the wheat, is that going to be really very reflective? A, I started out with a very low cushion, and B, yield potential for a lot of us is probably significantly less than what we thought this time in October. Let me show you a quick example. If we take those 6 regions, the average cost per acre was $396. If you take the average yield for all those 6 budgets, it was 51 bushels. So again, in an average year, the average farmer, we're thinking 51 bushels. You break that out at 772. But if we just, use a 10% reduction, that puts it at 46 bushels. That bumps that cost of per bushel to $8.58. If we think we're going to see a 20% reduction from average, not from our high potential, but just from average, that's a $9.65. So the question comes in: where is this cost of production based minimum target price now? And I think all producers across Kansas really need to be looking at that and kind of reevaluating if you haven't already. For this budget today, I'm going to use $9. So we're bumping that thing up $1. Okay. So here's that plan developed back in October. I think we were actually starting to show a tentative one back in our August and July webinars last year for the 2023 crop. Again, looking at ensuring 80%, well, hold it. I don't think we're going to produce that. So let's say 60% of APH. So we're making an adjustment. Again, the bottom line is, how many bushels are you pricing? How many bushels do you feel comfortable marketing? One of the things we always say in our workshops, if you're willing to use futures and options, you can really feel comfortable pre-harvest pricing 100% of expected production. But if you're only using pre-harvest tools that require delivery, things like forward cash contracts, hedged to arrive contracts, then really you only want to include in that pre-harvest marketing plan those bushels that you're comfortable that you can produce. Okay, so we all need to be adjusting the number of bushels that we want to put into our pre-harvest plan. Now, in our plan, we use 5 increments, and we're pricing 20% in each of those, or 20%, 20%, 20%. In the 4th increment, 30%. That last increment, 10. We've got pricing targets. We start a little bit lower. We use $10 July CME hard wheat futures for that first increment. We used 11, then we went up 12, 13, 13.50, and 14.50 for that final price target. Again, always bumping those up. The idea being that if prices rise, we just sell into that increasing, we stair-step our sales into rising prices. Obviously, if you've been looking at futures, you're seeing we're not doing that. And that's why we have date targets, right? So we said, hey, if we don't hit $10 July futures, by February 1, we wanted to take action anyway and price it at whatever price. And then if you look down below here, we ignore decision dates at the bottom line here, ignore decision dates and make no sale if prices are lower than, and we originally had thought $8 local cash price. Now we probably want to adjust that to $9, right? And again, the key thing here is, what is your minimum target price? This year, every year is important to know what your costs are. This year maybe is more important than ever. So how's our plan coming along? Well, in October 1, July futures were at 960. And I hope you can see my little arrow there, but we were at 960 on October 1. And that's why we were in a strong uptrend, right? If you look back in September and August, we were seeing prices increasing as we go into October. And so we were using a price target of $10, right, for our first increment. Well, we got there, right? We hit that on October 10. The close that day was 996. So we priced our first increment on October 10. At that time, we thought it was 20%. Again, as we adjust, that probably looks like maybe it was more like 27% of what we want to put in that marketing plan. Our next increment was another 20% of expected production there at $11, or by 3/15/23, which is today. Now, down here in that lower left side, I've got today's futures. I checked at 10 o'clock. I think I checked again at noon. We were trading a little higher than this, but at that time, CME July wheat futures were 806. Now, if we look at, Hutchinson's new crop bid of 10 cents under, Hayes 44 cents under, Garden City 35 cents under, it would give us new crop forward bids of 796, 762, and 771. Obviously, all of those are below even our initial target price of $8, let alone our new target price of $9. So we don't take action, right? We're going to skip past this date, and we're not going to do anything, and we're looking for $11 futures, or at least at a point where we can maybe price at a cost that would not ensure loss. So at this point, at these prices, our plan, we would say take no action. If we look at our feed grain plan, which we would use, say, for corn or grain sorghum, again, ensure at 80%, including 80% of APH as those bushels to price. Bottom line, how many bushels are you pricing? Is it a 30-year production? Whatever. At this point, though, we haven't got this thing in the ground. I wouldn't make any changes to my plan at this point. I think we can be aggressive. We might get some good rains and produce an average crop. And so, I feel fairly confident at this point in time to continue following our plan. Again, we've got 5 pricing increments, and we're pricing 20% the first, 20% the second, 20% the third, 30% that fourth increment, and then 10 that final increment. And again, starting at a lower price, 610 December futures, and then incrementing that thing up, staircasing it up, stair-stepping it up to 830 for that final increment. And then we also have our decision dates: March 15th, today being 1, April 15, May 15, June 15. I want to be done with this whole pre-harvest plan by July 15. And again, we ignore decision dates, make no sale if prices are lower than $5.50, which was at $5 and 1 cent cost of production plus 49 cents. And again, at this point, we haven't even got it in the ground. I wouldn't make any changes. So how are we progressing on our feed grain plan? We haven't priced anything at this point. January 1, we were at 607. And as you can see from the chart, we have never traded at that level since. We did get up there at 605, 606, maybe for a high. We had a target of 610. So at that point in time, we didn't do anything. We are at 315 today. So, now the next thing we want to look at is, can we price profitably? Now, again, I checked at about 10 o'clock this morning. CME December corn futures were at 556. And again, I'm just going to look at 3 locations across the state. Topeka, a 30-cent under basis for new crop bids. Salina, a 15-cent under. And again, this would be for corn. And Garden City, 45 cents over. So if we adjust those to get a new crop bid, we're looking at 526, 541, and 601. Topeka and Salina, neither one of those are offering me a price above my minimum price target. Garden City is. So, if it's working, maybe people out in that western part, that southwestern part, if your costs are similar to that $5 area that we had, you may want to consider go ahead and get something on the board at this point in time. For our plan, we probably say no, take no action. But if we can kind of see, and it looks like maybe that 551 could hold. We bounced off of that. We're starting to trade a little higher. If we can get this market back up to 580, we probably want to go ahead and price that first increment. We don't like the price, but it would be above my cost of production at this point in time. And so if we can see, say, a 30-cent rise, 25-cent rise in prices, maybe we go ahead. But at this point in time, March 15th, this plan, we'd say don't do anything. I'm going to jump over to the soybeans. Again, very similar type of plan. Again, keep the thing there. How many bushels do you want to put into your plan? Again, the same setup as we had for the feed grains. Ignore decision dates, make no sale if prices are lower than $12. For this average plan, this thing that we think is relevant, how is it progressing? Okay, in January 1, we were at $13.97. We had a price target of $14. And in there about February 21st, we actually hit that. We traded for 2 days where the high was above $14. And so we locked in close there at $13.99 on February 21. So we did our first increment. Next increment is another 20% at $14.20. Again, if you look at futures, we're a long ways from that. I looked again around 10 o'clock. I think we're trading a little bit higher than that when I look again at noon, but at 13.24 futures, and then looking at Topeka, Salina, and say Fredonia basis, 55 cents under, 50 cents under, and 75 cents under for new crop bids, it would give us bids of 1269, 1274, and 1249. So at this point, we're not at 1420, so we're waiting for that. But right now, the market continues to offer us prices that would appear to be above our cost of production on soybeans. So at this point, though, we don't take any action because we're waiting for that 1420 price. Again, I was hoping the 1330 level of support that we had seen back there in about mid to late January would hold. We'll see if we close below it, but we did start trading below that. So that it doesn't look real good on the soybeans at this point. But again, we've got a lot of time. This crop is not planted. So again, we're kind of holding. We've got one increment sold. With that, Dan, if you're ready to go, that would be the end of my slides. I'm going to stop sharing. Let's see here, stop sharing, and turn this thing over to Dan, and we'll go from there. Thanks so much.
Well, thank you, folks. Appreciate the chance to speak with you. And Mark, good job. I know you and I have discussed those price goals. They look really good. I think you have really appreciate your combination of both attainable up front and aspirational on the backside. What I want to talk about is kind of a grain market perspective first, and then as time allows to get into price projections and what the likelihood of volatility and these pricing opportunities might be this year as we go forward. Start out with grain markets. Let's see here. There we go. The great for grain market outlook in Kansas, U.S. and globally. First, globally. There we go. We're still dealing with tight global corn, other grain, and oilseed stocks across the board. And the last set of USDA numbers that came out only made that more of an issue. Brought about, again, the importance of South America's corn and soybean crops. And of course, we're watching closely the impact of drought in Argentina. And I think we're beginning to settle in, to factor in the longer run, how smaller crops and exports are very likely through Ukraine in coming years, even with the UN's help, et cetera, just enough war-torn damage there to affect the ending stocks of grain across the globe. And I would say, when you tighten things up, like we've seen happen, and I'll show you in just a second, when we tighten up, ending stocks, we just bring about more volatile, more inflexible prices. So smaller changes in production, tighter expected stocks to use brings a lot more of a price response. Either way, really, when you've got tight stocks like we have. So let's see what this is. So here you have the corn supply and demand balance sheet. This is all corn with China included. You can see over here the stocks numbers. We came out of 2021-22 marketing year at a 9-year low. That's at a 9-year low for stocks, and we're right now in. Came out of the 2021 marketing year pretty low, and then stocks to use is 24.5% was the 9-year low. Ending stocks this year just marginally, stocks to use just marginally higher. You see the 296 over there on the left, and if you look, if you can see as I move my cursor, strong growth, unabated, really, in total usage for corn, production up and down. So when you start to look at taking 5, 10, 15 million metric tons off the Argentine crop, you're coming right back into this production number, and that ends up and causes rationing of usage over here, and keeps a lid on where ending stocks can go. If anything, more attention getting to look at the world, less China from a corn perspective. We're at a situation now where again, the stocks to use figure for the 2021 marketing year, that 87 million metric tons with 10.1% stocks, was a 10-year low, and we're just marginally above that at 89. So you end up with this picture here, to where you look at the amount of stocks to use, the trends we've seen since 2016, and really you see from 2006, kind of focusing on the world minus China numbers, and mirroring what happens on the all world together. We've come down to a place where we're just apparently the market's loath to go much tighter, down to about 10.1% stocks to use, and you can see that the huge amount of stocks that we're accounting wise attributing to being in China. And there are questions, of course, about the quantity, about the quality of all that, but probably the real number to look at, since we can trust it just a bit more, would be that bottom purple numbers there. And you can see we've scaled ourselves down to about 87, 89, maybe 97 million metric tons, and we're just not going much lower. So Mark, as for your aspirational goals, any threats this spring to the U.S. corn crop, to other crops around the globe in the feed grain realm, are going to bring some price responsiveness. When in tight stocks like this, we're not in a situation where we can afford to just to lose part of a crop over here, a part of a crop over there. Every crop counts. Soybeans, pretty similar situation of soybeans, wheat, and corn. You've got probably soybeans is just a little bit better off, although awfully high prices, just a little bit better off in terms of the tightness. You can see again, you get over here and look at the stocks to use, same pattern. We've gotten to a place where we're just about going sideways. Usage is going up, production hopping around, and again, you see the Argentine crop loss. This number would be even lower if it given. You have kind of the battle of Brazil's anticipated large crop and Argentina's diminishing short crop because of drought. And take world minus China out of this, and we've actually been declining for about the last several years in a row, sideways to lower. For and this is the best of the commodities. we're sideways to lower in terms of about 65, 66 million metric tons, and that's the lowest we've seen in several years. We're at a 9-year low right now for beans. Take a look here at wheat. The world wheat stocks to use figures Again, you go over there and look at the numbers as they crank out. We've been declining for about 4 years in a row now. We're at an 8-year low. Current numbers. Take China out of that. Again, China has huge reserves of wheat in their food security policies, and we've been declining for several years in a row. The latest projection, the USDA for 2022-23, 19, just under 20% stocks to use is a 15-year low. You can see that really stands out here in the as you see the world less China stocks to use figures. We're the lowest really since back in 2007. Really an explosive time in agriculture. That's when we first saw prices jump up to, I think, hard red spring up to 20, hard red winter up to 13 or so. The first run at that, and so you can see that China stocks figure. So I guess my reason for starting out with this is that I know of late that that we don't have issues right in front of us, that we've seen some declines in futures, particularly in the wheat market, wondering where things are going, and I'd attribute that in the U.S. largely to just really poor exports, high U.S. dollar, really hurting us on the wheat side especially. But we're not in any situation where we're seeing any growth in stocks. We're just hoping any marginal increases we have, we're just holding the line basically. So I don't want to be just a rebel in terms of narrative thought for the grain markets, but we are, even though here in February, March, we've had a pretty docile time in the markets, we are not rebuilding stocks. We're at risk to any weather issue that would still come. So Mark, those aspirational goals you'd set for these markets, they're very attainable with any threats that would come about at all. Take a look at the impact of ongoing and possible geopolitical conflicts. Just to mention, the Ukraine-Russia war are there prospects for de-escalation of that and something positive for the grain trade? Basically I guess the fig leaf thrown out there, or the whatever the right terminology is, that would make people feel better, is that, well, the UN's involved in trying to make sure the grain keeps coming out of, that there are grain corridors coming out of Ukraine. And that's good that the market responds in a kind of a relief effort on that, or a relief attitude, but still not a lot has changed there. And we still keep watching China, Taiwan, and the tensions that come about there. And I know the amount of we witnessed the amount of volatility we saw in the grain markets through the Russia-Ukraine conflict. People were worried about again, Ukraine being a third of the fourth largest wheat and corn exporter in the world, and then being impacted, and they were, and we're seeing it in these numbers. But if China and Taiwan, or in that Asian theater, if that becomes an issue, I don't know where we would go. My own thought is that first of all, you'd see stock markets and commodity markets first go to cash. They tend to pull in until they figured out what was going on, but then suddenly you still have grain flow issues. China, predominant buyer for soybeans and grain sorghum, that would affect us on the negative side. The world starts to shift around where we move grain to get to different places. But we really don't know where that would go. Volatility either way, but that would be classified, I guess, as hang on to your hat type of a scenario. It makes you think about the use of options just to protect the black swan events that could be out there. Protect yourself from that. Do want to talk a little bit about, and I'll move really quickly through this, the carryover impact of crop production damage in our neck of the woods. So we just talked about international things. For us, I kind of, here in Kansas, in the Western Plains, I see us really reflecting our situation more in our basis bids. And of course, this Western Kansas, Oklahoma, Texas, Nebraska has had a carryover impact in other parts of the country. Stronger corn, soybean basis, sorghum right in there throughout the U.S. Corn Belt. And I know we have some people from the Eastern Corn Belt here. They would add in their, the low Missouri River system having impacted last year. That had carryover impacts on us. So really our question now, and Mark, you alluded to it, what with our depleted subsoil conditions, even with the moistures that we've had, what do we have better prospects now for spring, summer 2023 than we did several months ago? Probably in much of the state, yes, but the drought monitor maps still show depleted subsoil. So it's a great thing to get the moisture. I don't know that we can say we're completely saturated and out of the woods. Just want to show you here the Salina basis for corn, and move quickly. Note it's for this part of the year, this part of the calendar year, these are 48-week years, 4 weeks a month. And when there's a fifth week, we average the fourth and the fifth. So 48 weeks. And we've have a strong basis, but it has been declining in Salina for corn at positive 50. It was about 75 over, down to about 40 over. But really the question is for us now, where are we going in the last half of the year? I think that'll be a rainfall, crop production driven situation. Garden City, not as much decline for sure as in basis of over $1 over positive. This is looking at Garden City Co-op. I pulled this off of Ag Manager, off of bids from GTN, but note wide divergence in the last year of where basis has gone. So again, another stay tuned situation. And just to see, you can see that if you wonder where basis is strongest, you can just about lay the drought monitor map from last year on it, and there you go. Strongest out in the west, of course, demand centers and around Salina. Choose that as a kind of a central point, more of a transition zone. Still stronger, but strongest out in the west. Grain sorghum, not quite as strong, although pretty decent. Still positive for grain sorghum relative to the recent years. Again, you can see some real trends in sorghum basis in the Salina area, north central, and similar volatility, similar pattern, still positive basis for grain sorghum as well as for corn. But wow, lots of things happening in 2020, volatility in 21, ups and downs in 22 as well. And again, pretty similar map for sorghum as we'd seen for corn. Soybeans, we've had pretty decent export pace, surprisingly so. Rainfall in Brazil kind of slowed their harvest, and you can see we started out positive, a positive basis beginning of the year that in the blue for 2023. Now we're negative, but still historically the strongest we've seen in several years. And wow, if for our eastern Corn Belt friends, when the Mississippi River system started to have its issues, we started to see our basis jump all over the place. When people couldn't get soybeans out of the eastern Corn Belt, they were coming to us. So these are elevator train bids. This happens to be Cargill, Salina, so hopping around all over the place. Are we filling trains or not? Down to Columbus, we see some ethanol plant development. Really pretty strong basis bids down there, strongest we've seen for a while. Positive basis, but again, just a carnival of volatility for the last 2 or 3 years for soybean basis levels. And you can see strongest basis for beans, and probably not far from where we're either shipping or we're putting into an ethanol plant. Excuse me, a soybean crush plant. And for wheat, when you say, gosh, O'Brien, that's a messy chart, and that's the issue. The wheat basis is just about the same as it's been. And we're right in the middle of the scrum from where we've been about the last 3 or 4 years. We don't have strong exports. We have very weak exports. 1 or 2 weeks have popped out, but we're coming into the harvest time frame. I think harvest weather will drive this. We'll see if we have good crop prospects or not. But again, we're here in March. That's all before us. Give us the next 60, 75 days, and we'll tell you what the basis is. Colby, you see the Colby basis, same picture. If any, sideways, a little bit weakening, but just about where we've been historically. And you can see, of course, what's happened in the last several years. It kind of brings up an issue. Do we see seasonality in basis anymore? Well, yeah, of course, it somewhat, but anymore we kind of have sideways basis levels, and that's something for econ types like myself to think about. Why are we going sideways on basis more when there's nothing else going on, as opposed to having seasonal lows at harvest? And you can see some of the wheat basis patterns. La Nina, Mark already mentioned this. I don't think I need to mention it a lot. Jeff Whitworth in our shop at Kansas State, I'm talking about the anticipated transition from La Nina in 2022 to El Nino in 2024, and sort of a question as to just what we're going to have in 2023. But if we're transitioning, perhaps it won't be as dry. I think that's the hope. You can still see the drought monitor, latest one this morning, awfully dry, major parts of Kansas, everywhere except east central, northeast, and latest soil moisture anomaly, dry pretty much all throughout the state, up into Nebraska, Oklahoma, Texas as well. So we're waiting for rain. Long-term drought, objective drought blend just verifies again some awfully tough areas subsoil moisture wise. And if anything, my office is in northwest Kansas, and we've had some moisture, and we're thankful for that moisture. But still, long-term drought, and in the short-term drought, you can see on the left, that's helped. But long-term drought-wise, when you go down deep, we're not out of the woods. So we're farming by what's coming again in western Kansas. And you can see these dry areas around the globe, dry or not. And we're probably most concerned about, you can see that issue there in Argentina, dry conditions. The USDA numbers, it's not where they're at, it's where they're going. And for corn and soybeans, we keep shaving off not just 1 or 2 million, 3, 4, 5 per report. So I know the market hangs its hat on these supply demand numbers, and where else do they go? I understand that, but you're sitting here right now and with balance sheets that are already tight, and we're anticipating something even tighter coming on the next 1 or 2 months on the world stage. We shall see. Okay, let's check here. 1240. We'll move along here. I just want to show you, I know in our workshops, we talked about acreage and fertilizer, and borrowing straightforwardly from DTN. Thankfully, they put together these charts on fertilizer, so we can kind of monitor these things. We have seen fertilizer prices come down. That's a positive for corn. They're still quite high historically, and these are annual prices. That February 10th, Feb 10, that's 2010, 2011, February 12th. And so you can see where we've come down to where we're about matching the highs of where we were before. And anhydrous is still way above where we've been. And you can some downward trends now. This is I think this is diammonium phosphate. Oops. There's there's potash. So trending down, a help for cost of production, still not out of the woods. And because of that, corn acres projected by the USDA to be up from the previous year. The issue last year wasn't so much the planted acres, but the drought in the West did enough damage to acreage that 79.2, it's the harvested acres for corn, harvested acres for wheat that really got us, excuse me. For soybeans, projected to be basically sideways. And for wheat, that same issue, that 35.5 in the purple for 2022, that was us, in the Western Corn Belt, central Southern Plains in our drought. And talked with the USDA people, when they come up with that 38.4 for this year, they basically have assumed that our harvested to planted acres in Kansas, Oklahoma, Texas are the same as we had last year. So these numbers are assuming drought going forward to get us, and note, look at the percent harvested to planted. we haven't been below, basically been below 80 till the last 3 years of here of late, and now we're camping out there, and hopefully we get moisture and can get out of that trend. Overall prospects, U.S. crop prices supported at moderate to high levels until someday grain markets become confident that we're actually going to have larger crops and rebuild stocks. So, Mark and I putting together marketing plans and having people hold us accountable for what we really think. Until we answer that question, it seems that seasonally we'll hold up decently. When is that question answered? We get crops in the ground, we get underway, crops in the ground in May, usually get into June, uncertainty in July. If there's moisture there, then forward bids start to moderate, start to decline late spring and on into fall harvest. And of course, we've talked about some of these other crop impacts. In our workshops, we did show this to people. I did want to bring up that dry condition down in Argentina. You can see when those crops are supposed to come off and be harvested. So corn, mid-March now to early June. So they'll pull that crop off, they would normally bring that into world export markets to some degree. And so that ought to be supportive of corn prices with export demand. We shall see. And you can see the Brazil crop is anticipated second crop to come in decently. That would come in March, June. That crop was late being planted. So if you push that back, latest number I'd seen, about 20% of the crop's extremely dry, late planted. So we've got some things happening in South America that might give us some pricing opportunities for old crop and maybe new crop this summer too. Okay, so right now, look at the soybean corn price ratio favoring beans. And this was this morning at, well, I'm not going to tell you what time this was. It was this morning. Let's just say that. 1325, November 23 soybeans, D's 556 corn, D's corn, and ratio 2.38. About 2.3 is neutral. The long-term average is 2.5, but cost production has been trending different ways for these crops. And so right now you've got a little bit of favoring for soybeans. And the USDA came out and said we're going to plant more corn, not beans. So this is the market's response to that. Likely strong new crop competition for 23 planted acres. You think we'd be seeing that right now? Well, you see that once the planters roll, and if we have dry conditions or wet, then you'll see. Then you wonder, will you see the convulsive reactive markets that you often see? So right now, advantage soybeans. USDA reports, next reports, these markets tend to be volatile around these things. April 8th, big report on May the 12th. That's the first projection for the 2023 harvest that comes out. There was an Ag Outlook conference. They had some general numbers, but you really don't, even with that, you don't see an actual in the field survey until the September report. You have a farmer survey in August. And if you're looking for times when there's volatility, and Mark, we've picked our time frames for decision discipline, I guess, in these markets. They're in middle parts of the month. We're trying to come after the WASDE reports, trying to come not directly dead on these prospective planning reports. And there's there's stocks reports those same dates. So the idea is that markets can be so volatile either way that you wonder, should you be making marketing plans on those days? Still likely, if we have any dryness in Western Kansas, and by Western Kansas, I'm talking about from Salina west this time, Western Kansas, then with the memory of what happened last year for basis fresh in our minds, you would wonder about just how the the grain markets would respond in Kansas, and it affect all of Kansas and Nebraska, et cetera, if we start to see in any threat to these crops, given the basis issues that we just had. If that comes about, if we do have weak production prospects this year, then inverted futures, strong basis, all that. It's just, we're not looking at that right now. We're expecting El Nino to come in and give us moisture. If it doesn't, then volatility galore. Okay. I want to shift on and talk about, let's see. Going to quickly hit some markets to talk about where prices are at. Corn futures, the continuous corn futures chart. You know, you can see the highs we had. This is Ukraine, Russia, back in May of 22, fell off by the time we got into July, August, from 824.5 high to 561. And generally, after recovering from that, dry conditions gave us $7. We've been pretty much moving sideways to lower for corn. Seasonally, we tend to see from March on, tend to see prices move higher from March into June. You can see that on the green bar there, the March 101.9% of the seasonal average price, 107.8 into June, and then typically we tend to fall off. I wanted to show you all the current futures-based projections for prices for these crops and how they match up or not with what the USDA has projected so far. Current marketing year running again September 1, 22 through August 31st, 23. USDA has said they're projecting 660. If anything, actually, you've got with futures kind of declining now, the futures are tending to move lower. Now note that purple bar, that's moving differently than the seasonal trends. Seasonal trends, we'd be going higher into June. Right now, the futures, given what's in front of them, they're pessimistic. They're discounting out that time frame. So something's going to have to give. And then if you look into that next year, into 2023-24, and use hopefully reasonable basis assumptions, in essence, futures are just level and lower. USDA projected 570 futures with basis assumptions carrying kind of current basis forward, about 558. So I guess be thoughtful about that. If for old crop storage, there's not any, if we bet on old crop storage in a speculative cash market manner, the futures right now aren't acknowledging that. We'll have to bet against the futures to get those returns. And just some other things you can see here. The USDA said projected 570 for corn prices. You know, if you actually plug in their 12.8% stocks to use and see where it hits, that number, my own thinking, I'd put that closer to $5. 570 is where they've got, and but they also have 181 bushel, 181 and a half bushel yield. And to me, that seems, we haven't ever been above 170. We haven't ever been to 177. So plug into 177, assuming a record high yield, then we're closer to 610. So on the one hand, my good colleagues on the USDA, if there are any on here, I'm both more pessimistic than you are in terms of given your yield assumptions, but I'm more optimistic that thinking that those yield assumptions are a trend line long-term, probably difficult to attain, not impossible, but in thinking that generally my projection would be more like 610 corn. So I'm about from your 570, I'm about 40 cents, 50 cents higher. And you can see this in essence, just kind of a verification that what's being stated by in these markets tends to make sense in terms of the types of movements you've seen. For soybeans, you know, we could take the corn chart, put it on top of this, change the scale. It's really similar during the Ukraine-Russia situation, but we've seen more of an uptrend after all that shook out after fall in the soybeans than we have otherwise, and it's probably largely Argentina. Typically for beans, pretty similar, not quite as sharp of a run from March on up into June, and still holding pretty decent in July and then falling off into August. You can see the current marketing year numbers by a combination of cash we have in hand and futures out there. 1408 projected next year, 1281 US, and those aren't far from the USDA's projection. Again, what the futures are showing does not represent the type of seasonality that we tend to see in Kansas for prices, especially heading from here out into May, June, July. So I don't know what to tell you to do in regards to that, other than to know that the futures surely have their function, but right now they're not bidding in much seasonality of crop production risk. And for soybeans, you can see the USDA's projection 1290, 6.1% stocks to use, not far off. Don't have any qualms with that at all. And again, you can check this to see that generally we're kind of operating in a 4 to 6% stocks to use and about 13 to 14.5 range for prices, and that probably stay there until further notice. For wheat, last thing we'll show here, you see the wheat numbers come down to as yesterday. This is weekly numbers, closed about 818 and a quarter. We remember $10, and we're not very happy with the 818. Generally, our reference is the recent highs, or kind of our reference price. So we see this downtrend and are wondering why in the world that's happening. Probably largely because of poor exports, which you go right back to the US dollar for that. And again, so are we, what are the futures saying? So you're really jumping around current marketing year, 869, so what kind of the futures average would be 810 for next year. Not far off from the USDA numbers, except so I'm projecting hard red winter wheat, and the USDA is projecting all US wheat. So you can hard red prices generally a little bit lower than the others. And again, a little more conservative for prices. Notice I only put a 35% probability of my own Dan O'Brien's probability that number will work out. There's and maybe I'm too affected by Western Kansas dryness. I'm not sure we're going to get all the production and the types of yields they're talking about. But yet that's a number that's out there that will be proven or disproven. And you can see what's going on in terms of price movement. Again, we're kind of bound between 30 and 37%, and kind of hopping around in there in terms of prices. Okay. Well, our goal was to have a little bit of time left before you all had to leave at 1 to go and do whatever you needed to do. Is there any questions that you have that we can try to address? Mark, any comments from what you'd seen there that would be supportive or not of our the plans that we laid out?
Nothing specific. Like I said, I think you do a great job, and basically, as I listen to you, it's telling me if we've taken some action, yeah, let's all wait back and let's sit back a little bit here and see. The market is weakened so much that it's only soybeans were clearly offering us a profitable price, it looked like. And so, gosh, with stocks, as you described, the potential risks that are out there, and obviously the weather risk, it's just way too early. It's good to maybe get some sales on the books, but I definitely do not want to get ahead of ourselves.
Well, that seemed to be the case to me. I guess I sure respect traders who have money on the line and with the narratives that they're looking at, but it'll be good to get more data going forward to see if we have any of these risks to deal with, and to actually again get into April, May, June, July, and see how these crops develop. I guess we'll see.
Mark, you do have a question that came in the chat there. What happens with the marketing plans if no sales targets are ever reached?
Yeah, that is a great question. And, we talk about that all the time in the workshops. Part of our real goal here, let me get this right so you look at me even. Part of our goal with this is to create a plan that's not going to do any harm, right? We want to create a plan that'll force me to action when the market provides the opportunities, but not a plan that's going to force me into marketing at a loss. And so that's why, getting that cost of production estimate in there. And so like I say, we're looking at wheat right now. If we would have started this in October, like we did, we've got 20% priced. When the market's not offering a profitable price, we sure don't want to do anything pre-harvest. At that point, I guess basically, as Dan and I were telling people in our workshops, we're better off. Let's get it cut. If you can store it, see if you can make some money at harvest or post-harvest. But you definitely, in your pre-harvest plan, don't want to put yourself in a position that you're pricing at a loss. And so, to get at that, if it doesn't happen, if we see this market, let's say for wheat, continue lower and it never offers us, well, then we're not going to, we're only going to have that one increment sold. That would be how we would implement this plan. And we grabbed a few cents when we had the opportunity, but we didn't want to make any mistakes.
And in so many words, we're going to expand for those bushels, expand the pricing window to harvest and beyond. Given the volatility and tightness of world markets, see what opportunities come down the line. But the idea being not to lock in anything that doesn't help us financially.
If we got a second here, I would also just toss in on that question, because I think that question kind of begs, I guess really what it was really getting at is do we ever consider pricing at or below our cost of production? And I guess that's kind of where I think Ward was heading at there. I guess I didn't read the complete question. And I think, typically we always had one slide that would hit on that if we had time to hit on it in the workshops. But again, that's a very personal question that everybody's got to answer. Is it worth locking in a price that, hey, I think it is a loss, but maybe is it better to lose 20 cents today than watch this market deteriorate another 70 cents? And at the end of the day, I'm losing 70 cents. At this point, and I should have tossed that to Dan, but with the uncertainty out there, I'd hate to take a lot of action. But I think, as Dan did his outlook, he kind of alluded, and I will let him just hit this. We are going to hit a point in time when the market is going to make this decision that, yeah, we're good. We know what the wheat crop looks like. We know what the corn looks like. It's in good shape. Soybeans are they're in good shape, and it could head south. Now, when is that date? That's a tough one. I think it's too early right now, for sure. But yeah, there may come a time that maybe the market's not offering a profit, but we feel like, yes, it could head south because everything's pretty certain. Dan, do you want to hit on that a little bit? I know you've alluded to it before.
Yeah, and I think we're getting at the seasonal psychology of grain markets that has given us these patterns over various years. Again, why do we tend to hold up into June and then fall off in July? Well, into July and then August, for the reasons that was talked about. There's Mark, if you don't mind, there was a question from Brady Huck, or a statement to keep in mind: the cost of ownership for owning grain in an elevator has been changed by higher interest rates. Mark, we did in our in-person workshops here have a lot of discussion about how interest rates are coming into play, affecting hedge to arrive contracts and the fees that some elevators charge. That again, they're elevators holding grain for a period of time, and they're paying interest on that. Any thoughts from you on that?
Well, yeah, just to add on where Brady was heading. Yeah, I mean, the fact that, if I do nothing, because it looks like it's not offering me a profit right now. And again, our goal of our pre-harvest plan is not to do any harm. But again, is it better to lock in what appears at first blush to be a 10, 15, 20 cent loss because we're fearful that I don't want to end up with a lot of grain unpriced at harvest that I've gotten a bin and now I'm paying interest on. And that's kind of where Brady's heading. And that is a real risk. But again, that's one of those, if you feel comfortable doing those things, that's a good thing. I think definitely you need to have your marketing team. And that's probably your broker, the significant contributors, partners in your organization, but likely to your banker, because they're going to want to know why you're pricing at a loss or a potential loss. But again, I think as Brady touched on, and as Ward was sitting on, there is that time where, yes, maybe it's a rational thing to do to lock in a small loss for fear of a larger loss later. But again, gosh, dog, there is just so much risk. And every time I listen to Dan talk about, his outlook, stocks are so tight that it really wouldn't take a lot to pop this market up. He alluded to the fact of maybe, looking at a minimum price opportunity here to be able to take advantage of that. We might look at some examples in the next webinar of how those could work. But maybe, forward contracting now your soybeans or even your corn, and then buying a call and either an at the money or better yet, maybe an out of the money call that would be a little cheaper, seeing if we can get a run up here in the next 30 to 60 days, get rid of it at that point when you think the risk is gone. And that effectively would increase your forward contract price. I can show an example of that maybe the next time in our April workshop, look a little bit closer at that. But those are some of the things a person could consider. But at this point, I think with the uncertainty and one of the things we ask people, how many people, we ask for a raise of hands, how many people are using futures and options? And not many hands went up. So, when we do a webinar like this, typically we want to look at, well, what's a forward contract doing to me? And at this point, March 15th, I'd like to have an increment sold. I'd like to have some on the books, but I wouldn't want a lot.
Well, last comment I would say is, perhaps by doing this, looking at the plans that Mark had laid out, then at least we're prepping ourselves to have a paradigm to be able to think about what would happen if we did start to see any volatile upward moves in this, and to look at what proportions to price if we do see opportunities. So we're going to do these every month. Our plan is every month about mid-month through August as a follow-up to those other workshops, and hopefully that'll be of help to people.
All right. Thanks everyone for being on. Dan, Mark, thank you. We will be doing this again and we'll let you know when it happens.
Thank you all.
Thanks.
Thank you all.